Welcome to TSIB Talks, where we share information on construction insurance and its possible effect on your business. Enjoy our latest episode.
Hi, everyone, and welcome back to TSIB Talks. I'm excited for today's guests, both Valerie and James, who will be discussing the topics of wrap-ups and claims. So let's get things started. Valerie, why don't you start with introducing yourself?
My name is Valerie Zepeda. I am the claims manager for TSIB. I have been managing workers' comp claims for about 15 years, and for TSIB, about 5 years. I first started out on the employer side, and then I transitioned over to the broker side, and here I am.
My name's James Pfeiffer. I'm the Director of Wrap-Up Sales for TSIB. I've been in the industry since 2007. What's that come to, about 16 years, 17 years? Something like that.
Yeah,
Yeah.
16, 17.
So I've been involved in wrap-ups the whole time.
So James, tell me about wrap-ups. Just if I didn't know what a wrap-up is, educate me.
Sure. Well, a wrap-up is just simply a consolidated insurance program where for a specific project or a handful of projects, we would wrap the workers' comp, general liability, and the excess liability to sit on top, where the owner, the general contractor, and all the, shouldn't say all, but most of the subcontractors would be included in that single insurance program.
Got it. Okay. And then what is one of the most common challenges when you're trying to execute a wrap-up?
To execute it? Well,
and what are some of the obstacles that come up?
Well, it's certainly a significant cost. If you were to just go out and buy a wrap up for a project, there's going to be, the premium cost because you're buying the insurance essentially for everyone involved in the project. Plus, it's going to likely be a large deductible program, so there's going to be significant collateral requirements most likely. So the initial investment into setting one of these things up is a big hurdle, and the way we address that is by saying, well, yes, upfront, this is expensive, but if you add up all the individual costs of all the contractors involved in the project itself, and that adds up to say X, in most cases, depending on the size and scope of the project, that sum is going to be much larger than what it would cost to deploy the wrap-up insurance program. So once you can get past that cost hurdle, it becomes an easier conversation. So we do that by using some basic information about the project. And we have to make some assumptions, and then we'll put together what's called a feasibility study. And so that way we can demonstrate to the owner, this is what it will likely cost for all of your contractors to bring their own insurance to the project. And that'll get added into their individual contract prices. And then you end up paying that indirectly. It's their insurance. They have to pay for it every year, but they're gonna charge you a little piece of it inside their contract value. That'll adds up to that number, that X number. Buying it for everybody else, it allows you to buy it sort of wholesale, or sort of going to Costco for the project insurance. So it's likely going to be cheaper.
Got it. That's great.
I think so. I think it's pretty awesome. And there's a lot of benefits for doing a wrap up. Obviously, the cost is the big seller, right? But not to overuse the word consolidate, but you really are consolidating coverage. So anytime, if I were to take one of these random contractors that's on your project, maybe they're a big contractor. If it's the GC, maybe it's somebody smaller. Their buying power in the insurance marketplace is going to vary. The smaller guys are going to have less, the bigger ones are going to have more. So the ones with bigger buying power are able to negotiate better coverages and terms and conditions in their policy, or better limits. The smaller ones, not so much. So one of the big sellers for having a wrap-up as the owner or even the general contractor on a particular project is that you're taking this entire chunk of risk. All of these contractors, again, it's expensive, but you're able to negotiate superior terms and conditions with the wrap-up carrier. And those superior terms and conditions and limits are going to apply to everyone involved in the project. That's the main idea. You're consolidating the risk into a single policy. So you have got that negotiating power to get the best amount of coverage.
Gotcha.
Best terms and conditions and things like that.
Gotcha. And what are some of the hurdles that you face from the carrier side when you're trying to do a wrap up? Like, what are their biggest concerns?
Well, jurisdiction is always a question, right? New York is a very difficult place to to do wrap ups unless you're talking a mega project where your values are in excess of, let's say, $450 million. Projects smaller than that, it's likely going to be more expensive to do a wrap up than it would be just to let the contractors carry their own coverage. From a carrier beyond jurisdiction, the New York issue is just an example, but beyond jurisdiction, I would say scope of work. There's a big difference between trying to ensure, let's say, civil work versus vertical construction. Civil work is spread out over a large area.
Okay.
You're going to have varying degrees of third party risk where interactions with the public and things like that versus vertical construction, especially if you're outside of a major city. It's your construction is relegated to a single footprint versus miles and miles of road, for instance.
Gotcha.
So there's a lot of factors that go into how easy or difficult it might be to place a wrap up. I mean, I can't share the name, but several years ago we insured a rocket launch pad utilizing a wrap up, and most of just by virtue of what that was, most of the carriers didn't want to have any part of that. We weren't building the rocket ships or anything. It was just the place that the rocket ships launch from, and it was just by the fact that was involved. It was like, nope, don't want any part of it. We did find a home for it, and we had to make people comfortable with the underwriters comfortable with what we were doing. But sometimes it's not even a risk necessarily with the project; it's perception. So we have to deal with that.
So were the carriers scared of insuring this pad because the rocket can launch and then damage the pad? Is that, I'm assuming that's what it was?
Well, a wrap up is a course of construction type coverage. Basically, you're going to put the wrap up in place that's going to be active during construction. And for the GL, there's going to be what's called a product's complete operations tail. That could be anywhere up to 10 years after the project's completed. And in that tail period, the wrap up's going to cover what's called latent defect, right?
So if, let's say we have a client, right?
Yeah.
And ABC company was provided with a wrap up policy through James, then if there is an injury with the insured that falls under that particular policy, then it would be brought to me. And then I would assist the insured, our client, with A through Z of the claims process. So let's say, for example, John Doe at ABC company tripped and fell on the project. Then they'd reach out to James. James would say, let me put you in touch with Valerie so that we can get this claim executed for you and make sure that we have your worker on the road to recovery.
I think we have to also be careful too, because what can happen is wrap up projects, or if the workers know that there's a wrap up in place, they can be viewed as deep pockets, right? So I got hurt over the weekend. Let me go over to the project and fall down. So we have to. I mean, that can happen almost anywhere.
Oh yeah,
yeah,
absolutely. And in the claims world, that's called a Monday morning claim.
Yeah, exactly.
It's called a Monday morning claim. So they play soccer on the weekend, and then they show up for work on Monday sore, and then they claim to have twisted their ankle while they were clocking in.
Yeah, exactly.
Yeah,
exactly.
Yeah, those are common. I haven't seen one lately, but they're common.
Yeah. Well, and two, we'd have to make sure, was that injured worker enrolled in the wrap up as well, or were they an excluded party? Because not all contractors get enrolled, or I should say, not all classes of work get enrolled into a wrap up. Things
Gotcha.
like hazmat work, anything involving heavy demo or if there's blasting involved, that kind of stuff. Those risks would be excluded from the wrap up. The reason you do that is because you want them to carry their own coverage that would insulate the wrap up from those policies, but the owner would still be covered by whatever vicarious liability that excluded party brings to the project.
Gotcha.
So we're not enrolling them. We're not necessarily excluding their risk. Does that make sense?
Yeah. I get it. Where we overlap is you provide the wrap up. Right? There's an insurance policy in place for a certain job. If there's an injury on that job and that requires medical attention, then there's going to be a workers' compensation claim submitted to the insurance carrier in order for that worker to get the care that they need. the benefits that they're entitled to, and then also make sure that they get back to work for that contractor again. There is a connection there.
Yeah.
Yeah. So James makes sure that there's a policy in place to ensure that the contractor is covered and that their employees are covered.
Mm-hmm.
And then I take over the claims part and make sure that there is a system in place to make sure that the corporate interests of the subcontractor, meaning claims mitigation, which is the return to work program, which is the safety program, making sure that we are mitigating exposure and hazards so that we have less claims.
Yeah. Yeah. And less claims mean more money and more profitability for
Absolutely.
the insurance program.
Yeah,
'Cause
absolutely.
Going back, one of the main issues, one of the main I shouldn't say issue, one of the main reason of deploying a wrap up is because it's a savings tool, right? So we want to make sure that we can keep claims low, and the dollars that we're talking about are significant because most wrap up programs are going to be large deductible programs. So you're talking $250,000, $500,000 per claim. So those are the program sponsors' dollars, each and every. So whatever we can do to mitigate those losses, that just adds to the profitability of that insurance program. And obviously, the benefit of having a robust return to work, robust safety program is hopefully less people get hurt, and when the ones that do don't get hurt as badly.
Yeah, and ultimately, we want the employees to go home at the end of the day in the same condition that they arrived,
That's
which
the goal.
is just,
Yeah.
whole and healthy.
Yeah. And I think it's important to know too, and I think one of the other reasons why subcontractors, they don't all loathe wrap-ups, but I think most of them would prefer not to do them because you're in a sense taking control away from them, right? And if you're a subcontractor, like a drywall contractor or a bricklayer, whatever, you're contracted to a general contractor who is dictating terms of the contract, and they have most of the power in the game. If you want the contract, you got to do what the contract says. You got to abide by what the GC and the owner want to do. And if the GC and the owner want to deploy a wrap up on that project, you have very little say over it. So it becomes a matter of should you or shouldn't you do it. It's more of how do you navigate that better? How do you set up your insurance program on a corporate level to accommodate wrap-up work? And that we can talk about for hours.
Yeah, well, unfortunately, we are out of time, but thank you both for joining us today. I know I learned a lot, and I'm sure our listeners did too. Thanks, guys.
Thanks for listening to this episode of TSIB Talks. If you like this content, be sure to follow for new episodes. Until next time.